Thank you so much for attending, everybody who's here. And hopefully this will be an informative session on mortgage renewals, because I know Kim and I were fielding a lot of questions right now. So Kim is the expert on this. I'm here to answer any questions about the real estate process and what's happening in your market and things like that. But I defer most of my mortgage questions to qualified mortgage agents, because I find that it's changing all the time. There's been so much going on this year. And we were talking about this earlier today when we were getting ready. And over the last year and a half, really, and all of the interest rate increases and different things happening in the bond market and, rate increases that we're expecting still. So it's kind of an interesting time for everybody. A lot of renewals are going to be coming up, and they're going to be looking at rates that are quite different than their previous mortgage. So that's what we're hoping to talk about today. I'm going to do a bit of an opening to just kind of let you know about Kim and I, who we are and what we do. Then there'll be a short presentation, and then we will leave lots of time for questions if there are any. And if there aren't any, that's fine. I assume there might be questions in replays later on. And so if you are watching this in the future, do feel free to comment on any social media you see it on, or send us an email with any questions, or private message, and we will get the questions dealt with for you. So I am going to go ahead and share my screen now. I'm your host, Michelle Hawko, sales representative from RE/MAX Real Estate Center. And my speaker and guest today is Kim Boehlke with Premier Mortgage Center. And she is a level 2 mortgage agent with Team Finance Flow. So she's lovely. I have known her for years, and we've done a lot of work together. So about me, my background is in business and marketing, and I've been in the real estate industry for 17 years now. So it's been a while. I've helped a lot of families, and really everything has evolved into a really holistic approach over the years. It always kind of was that way, but now it's really having a look at people and their situations, and then tailoring my services to match what they need. So I see myself more as an advisor than a sales representative, because, there's so many questions, right? And nobody really needs to be sold to, I find, when they want to move. They just need really good advice. So that's what my business has been about. Most of my clients now are repeat clients or referred. So that is a lovely way to run a business. Really enjoy that. So I am always open to referrals. If you do know anybody thinking of making a move, I would be happy to help them. I'm also an accredited senior agent. So I've done a lot of work with people downsizing, right sizing, and moving into properties that really best suit their needs. So that can look like different things to different people. I've also had a lot of experience with helping people with estate sales and things like that. So if you do have any seniors in your life that are thinking of making a move in different stages, I am here to help. I have all the right connections to help make that process easy and comfortable and as lovely as it can be. I'm also a certified negotiation expert and a member of RE/MAX's Hall of Fame. So I say I provide real estate advice you can trust, pressure-free, judgment-free, of course, very client-focused, and I really want to help people build long-term wealth, and real estate is a great way to do that. So I'm going to skip over this slide. I'm going to tell you a little bit about Kim. She's got over a decade in the mortgage business. She is a wealth of knowledge with tons of life experience. And I know when I send people to come work with you, that you're kind of seeing the big picture of their life, right? So it's not about how big a mortgage you can get them into. It's about, what is going to work for their family, accounting for all of the other things that they have to think about. So she truly is there to guide people through every single stage, whether it's first-time buyers, seniors, whatever the case might be. She's a great person to talk to. And I put her in the trusted advisor role as well, because I never feel like Kim is selling to anybody. I've seen her work with clients. I've seen her refer clients to other places if that's what's going to be best for them. And that's really what it's all about, helping people find the right product to serve their needs. And your mortgage partner, absolutely. So whether you're looking for kind of out-of-the-box financing, construction financing, different things like that, Kim, I think, does it all. I'm going to pass things over to Kim. I'm going to stop sharing my presentation, and I'm going to let Kim jump in, because she's got a great presentation set up for us. We're not going too deeply into what has happened over the last year and a half. We're all kind of aware of the situation we are having with mortgage interest rates right now.
Okay, awesome. All right. So thank you guys for joining on a Wednesday night to talk about mortgage renewals. And I know there's a lot of worry about this because you're hearing about rates going up and you're thinking about your mortgage. So I'm going to jump in and give you some tools to help you. But a lot of you that are signed up are my clients. So please call me. We can work through numbers. It doesn't take long for me to do with you at all. We're going to talk about renewal versus refinance. So when your term comes up, a lot of you have 5-year terms. When that comes up, you can choose to either renew or refinance. I'm going to talk to you about the latest from the regulators, just the gossip or actual news. And then we're going to talk about amortization because it's funny. I'm a mortgage agent. I should understand amortization, but sometimes you forget what is it even about. So I'm going to really break it down for you because we throw around terms and then we don't even know what they mean sometimes. And then we're going to look at an example of a real life client and just work through their scenario so you know what to do. Okay, let's talk about renewal versus refinance. Renewal is your amortization stays the same. So if you guys were putting down a minimum amount when you bought your home and you were paying the CMHC, the mortgage default insurance, you have a 25-year amortization is what you had when you first took it. So if it's been 5 years, you have a 20-year. If it's been 10 years, you have a 15-year amortization. That is your amortization. So when you're renewing, your amortization stays the same. You have the best potential for rates because you've probably built up equity in the home, which can help in certain situations, in a lot of situations. And if it was an insured mortgage, those are the best rates. So there's 3 major kinds of mortgages: insured, insurable, and uninsured. The best rates are with insured mortgages. And the reason why is because of how the lenders, what they do with the mortgages once it's funded and how it shows up on their balance sheet. So you paid mortgage default insurance. They take those mortgages, they package them up, and they sell them as an investment product. And that makes it a very liquid asset. So it goes from being a liability on their sheet to an asset. So it's very easy to do that with insured mortgages. Insurable mortgages are the same, except for that you don't pay for the mortgage default insurance. You don't pay the premium. The lender pays the premium. They package them up and send them to investments. Again, it's better on their balance sheet. Uninsurable, those are the toughest. So those are when you're doing 30-year amortizations or when the purchase price is over $1 million. Those places are uninsurable. They still package those up into bonds, but it's harder. So that's why the rates go up with those different products. So with the renewal, generally you are most likely to have the best rates, especially if it's an insured, or we can convince them that it's an insurable product. We can talk more when you come up for your renewal. You do not get access to your home equity. So if you paid $300,000 for your home and now it's worth $700,000, you cannot access that equity if you're just renewing because it's just a renewal. Even if you're switching lenders, you're not going to access the equity because you're just renewing it. You're keeping everything the same. You're just paying it down. And if you stay with the lender that you have right now, there's no underwriting required. So we don't have to collect all your documents and that. You just get a rate from them and that's it. It's very, very easy. A refinance, on the other hand, you're either moving out your amortization. So maybe you have 20 years left. You want to move it back out to 30 just to reduce your monthly payment. You want to access your equity for whatever reason. Maybe you want to change the product. You want to make it more like a line of credit so that you can pay it off. Maybe you've started a business, you have extra money to pay things down, or you might need access to your equity. You want it to be able to take money off of it. That all is done at refinance. So again, you can do it before your term is up, but it's best to do it when your term is up because then there's no penalties and you can access that extra equity in your home. And definitely underwriting is required. So we have to refresh everything. So I hope that makes it clear between renewal and refinance. The next thing I want to talk about is regulators. So there's a lot of different regulators. I'm not going to talk about all of them. The Office of the Superintendent of Financial Institutions is the one who is always communicating with lenders about how they're underwriting their deals. So we always, it's so funny, like you have guidelines for lenders, you know what they say, and then you have the experience of dealing with lenders, and you know that, oh, there can be an exception made here, an exception made there. And they're the ones that'll say that exception that you're giving, stop giving it. And we don't know until we send in deals, which makes things very interesting. So communication came out because what's been happening is let's say you have a variable mortgage with TD. So you have a set payment and maybe you were only paying 2%. And then prime went up, 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 up. Well, your payment was still based on that low interest rate. So your payment didn't go up because that's how TD does things. And so now your amortization moves out because you're not paying as much principal because the interest rate went up, but your payment didn't go up. So now, what we've been seeing is amortizations are going out without you doing anything. Your amortization is getting bigger because you're paying down less principal. And we weren't really sure what the regulator was going to do about that, what the banks were going to do about that, but apparently they publish that they expect people to stay within their amortization. So that means they're going to force people to increase their payments, even if their payments haven't gone up. So that's a really interesting communication. The other thing that they've said is they're going to increase capital requirements. So how I was saying they take those mortgages and package them and sell them. So again, that's how the lenders have to pay attention to their balance sheet, and certain assets are liquid and some are not liquid. So they're wanting more liquid. So that's why you'll see the difference between an insured rate and an uninsurable rate get bigger, because now they have to keep more liquid assets, which makes sense, right? Because there's less savings in bank accounts right now. The other thing that this is more of a rumor, that we hear that there's going to be changes to rentals. They're going to make it harder to qualify for investment properties. I haven't seen anything specific. I haven't experienced anything specific, but that's the rumor. Home equity lines of credit, they're going to make those harder to qualify. They're already harder to qualify than a regular mortgage. And what I have heard is some older types of HELOCs that were set up many years ago gave access to more of your equity on a revolving basis, and they're starting to bring those down. So that's kind of interesting. It doesn't affect very many people though, because not that many people set up home equity lines of credit like 10 years ago. That's who it would affect. And then also access to all credit. So a lot of times when I'm doing a refinance, we need to pay out products. We need to pay out credit cards. We need to pay out lines of credit, but they never say you have to close it. I haven't had that very much since I've been a mortgage agent for the last 8 years. But now they're saying, we want people to start reducing how much access they have to credit. Like, you can end up with access to all kinds of credit that you never use. And when you do a mortgage application, you've never used it. You have access to this Amex with 20,000 on it. Well, now they're saying, hey, we're going to say you need to reduce that. So that'll be interesting. I haven't seen it yet, but that's what they're saying. Let me see if there's anything else I wanted to cover on this. Yep, I got it all. Okay. Now I want to take you guys to this really interesting tool online that anyone can access. So I'll just open up a tab here, calculator.net. So all kinds of stuff here. The one that's actually the best for what we're going to do is the loan calculator. So what I want to do is, I had a client, they had bought a townhouse in Oakville, and their loan amount, it's been 4 years ago, their original loan amount was $414,000. They bought insured. It was a 25. Okay, so this is a US site. So in the US, the loan term and the amortization is the same. So we're going to don't get confused about that, but we're going to use, so I'm using 25-year loan term. There's no such thing in Canada, but that's what I have to do to make it work here. Their interest rate originally was 4.29. And it was compounded semi-annually. Most mortgages are compounded semi-annually. Okay, so there we go. So their payment every month was $2,243. So that was their original mortgage. Okay, now you might say, Kim, why was their rate 4.29? Well, this was a bit of a different case. We needed a massive amount of cash back to make their mortgage work, and I'm so glad we did. This was like a mini miracle, this mortgage, actually. So proud of it. But anyways, their rate was 4.29. Worked out really good for them though, because their place is probably worth close to, they bought insured. So no, they bought with 20% down. So I think their place is worth close to $1 million now. So they're doing very well, and they needed a place. So it's good. Okay. So this is the original scenario. So for you, what you want to do is take your mortgage, and all of my clients, I have your info. So you can always contact me, or if you don't want to contact me, or it's 12 at night or something when you're doing this, you can look to what you originally signed with me, and I'll have all this information. There'll be an entire amortization table. So, but figure out what your original loan amount was, your original amortization, and you'll know because the payment will match. So you're like, okay, yeah, that's my payment. Yeah, this all makes sense. I had a 25-year amortization. Blah, blah. So here we are. So here's the original scenario. So this client wanted to know, okay, in the current environment, what's going to happen? So I looked up what the current rate was for his product, and it was 6.29. So all I got to do is put in 6.29 because the amortization is the same. Like, even though he'll have only 20 years left, it's based on the original amortization table. So if we do this as a renewal, all we have to do is change the rate and then calculate. And you'll see the payment is $2,720. So it's really only a difference of $477 a month, which, I mean, that's not an immaterial difference, but it might not be as bad as you think. Now, if you click here, you can view the amortization table. So what amortization means is that the beautiful thing about mortgages, see, I was even saying to Michelle, it's kind of confusing because like the rates go up so much and you think, oh my God, but because you're paying down principal, it's not as bad as you think, because every time you pay down that principal, you reduce your interest. So what amortization means is if you have that rate over that many years, you will have paid it off. And in the US, they have rates as long as the term. So in Canada, when we do a 5-year term and then we do an amortization table, it's kind of confusing because what's the chances that you're going to have that same rate over the next 30 or 25 years? Like pretty much zero, but they have to have some amount to use. So it kind of gives you an idea of how it works. And so you can look at these amortization tables and understand, oh, okay, it goes on and on and on and on. This is doing the entire 25 years, right down to zero. So of course, the longer it goes, the more your principal. Like here, so when you start a mortgage, you're just paying $500 in principal. By the end, you're paying mostly principal. So that's why, even though the interest rates double or triple, you aren't having a double or triple payment because of the amortization, because you're paying down principal. Okay, so now that's a renewal. Hope that's clear. Now let's talk about, let me see if I want to talk about anything else. Okay. No, I'm not going to talk about that. We're going to go on to renewal. Okay. So now, sorry, refinance. So with a refinance in this scenario, if you're coming up for renewal and you have a lot of equity in your home, we can actually refinance. Even if you don't want to access equity, we can push out the amortization because now you have a ton of equity in your home. So if you had put down only 5% or 10% or whatever the minimum was, and now your place has gone up a lot in value, we can actually, because your place has more value and because your loan amount is less than 80% of the value of the home, we can actually, 80% or less, we can actually push out the amortization. So if you're going to do that with the refinance, you have to know what your actual mortgage balance is. And if you've done a mortgage with me, you have an amortization table. And if you've kept your payments the same, you'll know your balance. You just have to look at the month and look at the balance. Of course, you can log into whatever lender you have and it'll show it exactly. So with this client scenario, their actual balance at renewal is going to be $371,874 if they didn't make any extra payments. So then if they just want to, reduce their payment as much as they can, we can move it out to a 30-year amortization And then with the same interest rate, their payment is $2,279. So their original was $2,243. Now it's $2,279. So that's only an increase of like $30, $36 more a month. So refinance, for any of you that have had an incredible increase in value, is something we can look at to reduce the cash, to make the cash flow not so stressful. Of course, you're going to pay more interest once you move out the amortization because you're taking longer to pay it off. But that's just the contractual amortization. So it gives you the most flexibility. If you want to reduce your actual amortization, you just make extra payments, and that'll reduce your actual amortization. So I hope that's helpful. I guess I can go back to the presentation. I think that's it though. Here we go. Yes. Oh, those are the two examples. And that's it. And then for sure, if you have any questions, give me a call. I'd love to connect with you. Love to go over your scenario. Don't worry, amortization is going to work in your favor and it's not going to be so bad. And then rates are going to go down. They're going to go down and you'll be used to paying more and it'll be all for your benefit. And I will stop sharing my screen.
Awesome. Thank you so much, Kim.
No problem.
That was very helpful. Lots of information. There's a lot to consider, a lot of math, a lot of different options for people. So I think that's really the important message. So if you do feel kind of stuck, there might be some different ways to kind of go about it to ease those payments for you if that's necessary. If you guys would like any information, we are able to do one-on-one appointments. Just reach out by email or phone or direct message, however you want to do it through social media, and we can certainly get back to you. Thank you so much for tuning in. This was recorded, so the replay will be available if anybody would like to see it. So anyway, thank you so much, Kim, as always.
Thank you.
And I'll look forward to having another webinar with you soon. Take care. Thank you.
Sounds good. Bye.
Bye.